Have you ever wondered why house prices fall even when everything else is getting more expensive? What if I told you it has everything to do with something you cannot see? Interest rates? Today's video will make you feel like a real estate insider, even if you are just a curious learner. Before we begin, if you want more videos that break down complex financial topics into plain language with real-world meaning, make sure you subscribe to this channel. And here is a challenge. After watching this video, drop a comment telling us how rising interest rates have affected you or someone you know. It helps us understand what content helps you most, and we reply to every thoughtful comment. Let us get started. What happens to real estate when interest rates go up? It might sound like a technical topic, but it affects everyone: investors, homeowners, tenants, and even the value of the home you live in. In today's video, we will break it all down into simple, real-life concepts. By the end of this video, you will understand exactly how rising interest rates shake up the real estate world and what professionals do to manage it effectively. Let us get started. First, we look at falling property prices and the concept of the capitalization rate. The first thing rising interest rates do is push property prices down. To understand why, we need to understand something called the capitalization rate, often called the cap rate. Think of it like this. If you bought a shop that earns $100,000 a year and you expect a 5% return, then you would be willing to pay $2 million for it. Because 100,000 divided by 0.05 equals 2 million. But when interest rates go up, safer options like government bonds start paying more. So now investors ask themselves, why take the risk of buying real estate if I can get a similar return from safe government bonds? They demand a better deal. Instead of a 5% return, they now want a 6% return. Now the same 100,000 in income is worth only $1.67 million, not $2 million. That is a big drop in price. So when interest rates rise, investors expect higher returns. That causes property prices to fall. Next, let us look at how borrowing gets expensive and how that affects the real estate business. Most real estate deals use borrowed money, like taking a loan to buy a house, but on a much larger scale. When interest rates rise, loans become more expensive. A developer who borrowed money at 5% last year might now have to pay 7 or even 8%. That means higher monthly payments and lower profits. So fewer people want to build or buy new properties, especially if they are not sure they can cover the new loan payments. Here is a simple example. Imagine you are planning to open a new cafe. You made your business plan, assuming your loan interest would be 5%. Suddenly, the interest rate becomes 8%. Now, your monthly loan payment is too high and your plan no longer works. The same thing happens in real estate. Projects get delayed. Deals fall apart. Activity slows down. Now, let us talk about how investors change their behavior during rising interest rate periods. When rates rise, investors start asking which properties can still give them steady income, even if rates stay high. They shift their money into properties where rents can be adjusted more often, like apartment buildings and warehouses. Why? Because these properties often have shorter leases. That means the owner can raise the rent every year or two if inflation goes up. On the other hand, properties like office buildings usually have tenants who sign long leases, sometimes for 10 years. That means rents stay the same for a long time, even if the market changes. This concept is called duration risk. In simple words, the longer you wait to get your money back or raise your rent, the riskier it becomes when interest rates change. Now, let us talk about how real estate professionals deal with all of this. They do not just sit and wait. They adapt using smart strategies. First, they get creative with financing. Instead of using traditional loans, some turn to preferred equity. This is a flexible kind of funding that does not demand fixed payments right away. They also buy interest rate caps. Think of this as buying insurance. It protects them from rates going too high. For example, even if the market rate goes up to 8%, their loan rate stays capped at 6%. Second, they focus on improving their buildings to save money. They use energy-efficient systems and smart technology to cut down on electricity and maintenance costs. This means more profit even when rents do not rise. Third, they change what they invest in. Big investors like pension funds or real estate trusts may sell old shopping malls and instead buy data centers or warehouses. These are places where demand is still growing. Lastly, they communicate better with their investors. They create clear reports showing how a property would perform if interest rates go up or down. These reports are called sensitivity analyses. They help investors see the risks and make better decisions. Let us sum it all up. Rising interest rates lower property values because investors want better returns. Loans get more expensive, which slows down new real estate projects. Investors move their money to safer, more flexible properties. And smart professionals adjust their strategies using new financing tools, smarter buildings, and better planning. So, while rising rates may seem like bad news, they also create opportunities for those who know how to adapt. Thank you for watching. If you made it this far, you are exactly the kind of person we love creating content for. So do not forget to subscribe and turn on notifications. And tell us in the comments, what is your biggest concern when interest rates rise? We would love to feature your response in a future video.